All right, I have noon, so we're gonna get this thing going. I'm Michael Chesney. I'm the Director of Communications for the Delaware Division of Small Business. I'll be leading today's conversation, but I'm gonna start by passing the baton over to the Director of our division, Jordan Schultz. Jordan.
Hi, everybody. I'm Jordan Schultz. I'm the Director of the Delaware Division of Small Business. I just wanted to take a minute to welcome everybody today. It's exciting to see some of the faces or rather names that are joining us. I know some of them, some of you guys were able to join us yesterday, so hopefully you were able to get some good takeaways from that webinar and this one as well. One of the things we hear over and over again when we talk to our small business folks is that access to capital is a really big deal. So out of that, to celebrate Small Business Week, we wanted to host these webinars to kind of give you some more resources at your disposal, maybe walk away with this with a new idea for your business. Also wanted to take a moment to highlight the Angel Investor Tax Credit that is also administered by the Division of Small Business. It is a chance for investors to get a 25% refundable tax credit if they are investing a minimum of $10,000 in a qualified industry. Those are going to be your high-tech industries, fintech, biotech, amongst other things. So if you want some more detail on that program, we would recommend heading to our website, delbiz.com, or you can reach out to one of our regional business managers with any specific questions. I'm going to turn this back over to Michael, and he's going to give us today's outline.
Thank you, Jordan. Okay, so we're going to run this like basically an extended Q&A session. I have a whole bunch of questions for our panelists today, and I'm going to give me 1 second to stop sharing my screen so we can pull that up. All right, so you can see on our screen we have 3 wonderful panelists with us. I'm going to introduce them one by one, give you a sense of who they are and why you should be interested in what they have to say on the topic. I think I may have just lost Glenn, but hopefully he'll pop back in. All right, so first up we have Ellen Weber. She's Executive Director of Robin Hood Ventures, which is an angel group helping to grow startups in the region. She's also Executive Director of Mid-Atlantic Diamond Ventures, which is a venture forum for early stage companies. Decades of experience with businesses of all kinds, from emerging to Fortune 500. Was named to the Philadelphia Business Journal's Power 100 in 2017, 2018, 2019. When you get to staying power on that list, that's someone worth knowing. And she also happens to teach entrepreneurship at Temple University's Fox School of Business, which is how I got to meet her, and also got to meet Glenn. And Glenn is he co-taught the entrepreneur class with Ellen at Temple, but he's also an active angel investor in areas from tech, real estate. Glenn, I have to say I was a little surprised by this one, but it said daycare. So maybe you'll have to share exactly what that was. And business services as well. He's also managing member of Robin Hood Ventures, chair of Mid-Atlantic Diamond Ventures, and has worked in the real estate and engineering sectors. And then last but not least, David Liss is a managing member of the Delaware Idea Club Investments. It's a Delaware-based angel investing group formed early last year. So interesting timing around the coronavirus. Maybe I'll have to ask you a question or two about how that has played out. But David does advisory work with Horn Entrepreneurship at UD, volunteers as a coach and mentor for startups, and has worked at Gore for about 3 decades, dealing with a lot of different industries and technologies. So the point is, we got a lot of people here who know a lot about what investors are looking for and how you can do the best job possible of pitching them. So before I jump into some questions, guys, did I miss anything? Is there anything else you want to add before we launch into this?
Oh, great job. Thank you.
All right. So Ellen, we'll start with you to give us kind of a baseline here. Talk to us a little bit about the funding cycles, what that looks like, and how angel investors such as you guys fit into this?
Sure. So, to start with, most entrepreneurs will self-fund for as long as they can to get to what we call product market fit. And I'm sure we'll talk about that more later when we talk about, what we like to invest in. But most, the funding cycle usually begins with self-funding, whether that's, working a side hustle or consulting or using credit cards, whatever it might be, try and self-fund. And then there's the next step, which could be business plan competitions or different types of grants. Then what we call, friends and family money, where you reach out to people that and see if they'll invest in you early because they like you and love you. Crowdfunding, which I understand you had a program on yesterday. And then at the time that you've hit, product market fit, that you can prove that, you've got a product that the market wants and is willing to pay for, angels are generally the first organized institutional expert type of money to people to invest. And we'll go into more detail about what angel investing looks like. Subsequent rounds are usually done by, if necessary, would be done by, and I definitely, when I talked about grants, I don't want to forget the state organizations and the funds that they have. That's a very important source of capital for companies. And then after angels, and there's individual angels, there's angel groups, there's syndicates, there's all kinds of flavors. We'll get into that into more detail. Then come the venture capitalists, and then there might be private equity, there might be bank loans, there might be some creative debt funding, and then what we all hope for, if you are asking investors to put money in your company, comes the exit. And then hopefully you get to start over with another company. So that's the funding cycle in brief. And so we come in kind of, after you've gotten enough money to get the company started and launched. That's when the angels come in, when you're really trying to grow the company and scale.
Great. And before we keep going, I do want to mention, if anybody has any questions as we go through this discussion, put them into the Q&A. I've got staff monitoring that, and they're going to feed the questions over to me. So if something comes up, if you're interested in something, put it in the Q&A, and we'll try to get it to our panel of experts. So we have two organizations represented here, specifically Robin Hood Ventures with Ellen and Glenn, and then David with, you know what, I want to make sure I get it right, Delaware Idea Club Investments. So let's talk a little bit just specifically about each of the groups. So Ellen or Glenn, do you want to talk about Robin Hood?
We'll let Glenn do most of the talking about Robin Hood. I'll do the more generic.
Robin Hood's been in existence for over 20 years now. We've done about 90 deals over that period of time. The typical Robin Hood deal is an early round in a company. And by early round, that's sort of a sliding scale, because it used to be that we said we did seed stage and A rounds. And now there's this thing called pre-seed and pre-seed. And so it's a little bit confusing, but the way we like the community to view us is we want to be the first money in. We want to be able to partner with founders who are raising their first capital and be able to bring to bear our expertise, our experience, and our connections to help those companies be successful. Unlike many other early stage investors, we do write term sheets, we do negotiate the deals, we do lead deals, and we do take active board participation roles. So all told, we want to be a partner for our portfolio companies. And what that usually means is we're check writers between $250,000 and $750,000 in the first investment. And we are active follow-on investors in our portfolio companies over multiple rounds. So that's who we are. Traditionally, we were focused on the Delaware Valley. That grew to the Mid-Atlantic And now we tend to look even more broadly, but still focus on those companies that we can bring to bear our experience to help be successful. So that will always be those that are geographically proximate to us. Right now, we've got about 10% of our members are in Delaware, either live in Delaware or work in Delaware. Another 15% are in New Jersey. And then we've got most of the rest are in Pennsylvania, or now, as is the case, when you're around for 20 years, people decide to go to tax haven locations like Florida and Nevada. So that's us.
Great. Thank you,
Great.
Glenn. And David?
Great. So Delaware Idea Club Investments is really a new group. We started as a group of friends. Our kids grew up together. We would regularly connect and talk about investing, and really kicked off the group with an exciting investment about a year ago. We've invested about $1 million total in the year, over about 8 investments. They've ranged from the same early stage that Robinhood has talked about, and we've also done some experimenting with some pre-IPO. So we're trying to figure out what our sort of sweet spot is. A lot of our focus has been upon where there's expertise in our group of about 30 to 35 members. We've got a number of doctors in the group, so medical and biotech is an area that deals have naturally gravitated our way through connections that we've had within the group. We've also invested in a few fintech areas, and a little bit in real estate as an experiment as well. Typically, our investment sizes are smaller. They're ranging from 25 at the low end up to our largest was 350,000 over that year. And really, it's been tied to where the interests and expertise within our group can understand the business, and also offer some connection and network building, but also wanted to stay engaged and get some updates. So we're not taking the positions and driving the deal sheets that we talked about with Robinhood, as we're trying to understand where we can have the best impact, and looking at things that just excite members in the group.
Great. And so we'll jump into some of these questions. I want to be clear, we talked a little bit about the industries that you guys have been focused on with your angel investing efforts. And, this webinar, of course, angel investing really does focus on these hopefully high growth potential industries. But what we're going to talk about will hopefully be useful to anybody who is bringing a pitch to any kind of investor. So just if you're watching this, you're not necessarily in biotech or fintech or something like that, that doesn't mean that what we're going to talk about isn't going to be useful to you in helping to fund your business. So let's start with this broad question, I think maybe for David and Glenn. What are you looking for in a company? You've touched on it a little bit, but kind of more broadly, like what is it that says that might be something I'd be interested in?
So I can start. So for my group, it's about something that sparks an interest in the team, and it has at least the perception that it can lead to a good return on the investment. So clearly, we're looking for returns, and know that you have to sprinkle your bets across a number of areas. We want to make sure that there's at least a portion of the group that's excited. So we screen some deals to get an idea of whether it looks like there's some business potential, and having a fit with what their offering is and market potential. And then we look to see how many people are energized to learn more and to dig in and do some due diligence on it. So there needs to be a connection, and that connection typically ties to the areas of expertise of members within the group.
Durable, demonstrable differentiation. That's what we invest in. That means it can be in multiple industries. We have investments in everything from biopharma therapeutics, diagnostics, advanced materials, all the way down to consumer products in ice cream and sofas. Okay, but the key is every one of these companies has a differentiation in their market that they can show and is readily apparent to both investors as well as the public, and is durable, meaning it's protected by intellectual property, market positioning, or something else. So that's what we're into. The second part of that is we also invest in leadership. Because we're investing before often business models have been proven to be successful, we've got to have confidence in the leadership, and we have to have some understanding of what the addressable market is, and that it is something that this leadership group can drive the company towards. But it really does come down to the 3 Ds to start.
Can I specifically hit on a company that people in Delaware may be familiar with, that Robinhood has certainly played a big role in? Either this is because they know the founder who's from Delaware in some form, or because they saw the Shark Tank episode. Can you guys talk to me a little bit about Simply Good Jars and kind of how, I think that's a good example of a business that isn't super high tech, but you know, came to you guys and maybe a really good representation of what outside of that space you're looking for. Can you talk to us a little bit about that?
Sure. I think Simply Good Jars is an excellent example, again, of the durable, demonstrable differentiation, right? This is a food company. At its core, it's salad in a jar, okay? Which you go, okay, anybody can put the components of salad in a jar and sell it. There are lots of pre-made salads on the market in virtually any food outlet that you go to. What makes Simply Good Jars different? The quality and the consistency of the product, how it's packed, and how it is available in the public. So pre-pandemic, one of the differentiators there was that they were putting the salads, the jars, in vending machines in workplaces. Obviously, they've had to grow beyond that. And, that's a dynamic leader in the CEO who said, look, we need to do things differently. So they've done direct to consumer as a result of the pandemic. And now they're looking at much, much larger distribution partners on a go-forward basis, as the question remains, are people going to be back in traditional workplaces, offices, or not? So absolutely, direct to consumer, there's no question about it, but doing it in a fundamentally different way, and a way that people will grasp, and that they'll be able to preserve a market on a go-forward basis.
All right, let's go to a kind of a broad question. I think maybe we'll start with you. What makes a great pitch? What's the differentiation there?
Okay, so what makes a great pitch? First of all, we want most of our questions to be answered. So there are some basic things that you need to cover. You need to cover what's the problem or the opportunity. Why hasn't this opportunity been explored before, or why, what's currently in play, and why isn't that working? Why is your solution better? Why are you going to win? Why are you the team that can execute on this? How big is the market? We want to dream alongside you. So we want to see a great big market, which is top down. We want to see that supported by bottom up numbers, which really give us a sense that you know how to get there, that there's a good go-to-market strategy, that you can capture that market. We want to know We really want to understand your business model and the revenue model. If it's tech, we want to, or in a lot of cases, we want to understand, what's the cost to acquire a customer. We want to understand the lifetime value of a customer. We want to know that you're thinking about all of these things. We want to see your projections, and that can be very simple. A very simple table to show those projections. We want to understand what the exit might be. We want to understand how much money you need and what the terms are for the deal. And if you don't know what the terms are, you can say that, but that means we're going to be setting the terms. And in any case, there'll be a negotiation about it. So those are the most important things that you want to cover in a pitch. Someone had asked in the Q&A, how polished are the presentations that we see? And they really cover the gamut from, pretty raw to super polished. And so for someone who hasn't pitched before, what I would recommend is participating in some of the forums where you get to practice your pitch. So Venture Forum does a program on Thursday nights where you can practice your pitch in front of people. Million Cups has a program, and I don't know if you've got one in Delaware, but they're all over the place. You can do Million Cups. Robinhood has office hours. Mid-Atlantic Diamond Ventures, you can apply. We'll give you some feedback. The Small Business Development Center can give you feedback. There's SCORE that will work with you. So there's a lot of ways to practice that pitch before, you actually get in front of an investor.
So I want to hit on one thing, maybe from a question from our Q&A, and also touch on something that you just said. And I think a great, I don't know if this is off the top of your head or just something that you've said before, but what a great line. We want to dream along with you. And that's really, I think, nicely encapsulates what this whole thing is about, convincing somebody that it's worth dreaming alongside of them. Can you talk a little bit about how important the decision-making process is, how important to the decision-making process is the delivery of the presentation? This is coming from our Q&A. So, how well prepared somebody is, the actual interaction that you have. How important is that in terms of making a decision versus any beforehand due diligence you may have done or afterward due diligence you may do?
Do one of you two want to take that, or do you want me to grab that?
Sure, I can start a bit. So for us, we don't restrict to the 8-minute pitch or 10-minute pitch, but we actually look for that same content in sort of a longer period conversation. What's really important is really understanding the story behind the business model. Typically, we have a lot of tech components in some of the areas we're looking at. So we've had plenty of pitches where they're really focused on the tech, but the story on the business model doesn't hold together. How do you actually wrap everything else around the actual technology? What is the value proposition? How does that relate to the customer segments you're going after, and how does that all roll up into a good opportunity? So having that is important, and also the degree of polish of the pitch. That's probably less critical that it's a perfect pitch, and it's more that it's a perfect story. And there are some folks that are really good at pitching, and there are some other folks that aren't. What we're looking for is the person authentic. Can you get a sense of where it'd be good to work with them? Do you feel comfortable that you're going to always have a good view of what's going on, even when things aren't positive, or is it just kind of glossed over and some of the risks and some of the challenges aren't actually brought up? So for us, looking at what it takes to understand the opportunity and give it some more time if needed. We'll have follow-ups what questions are there, but we want someone that's really open and honest and shows high integrity in the conversations.
There's an interesting deviation that we see too often, and we need alignment. And by alignment, I mean if the founders are going to do well, as investors, we want to do well, and vice versa. And if deals are structured and the expectations of founders are not well aligned with the returns of the investors, it's what sets off more red flags than anything else. The expectation is that we are putting in risk capital, and we will be rewarded for putting in risk capital. And if that comes out of alignment with the company, and one of the ways it does is we almost never fund a company where our funding is going to go straight out the door to the salaries of leadership. Now, we want our money going in to scale the business, grow the business, and ultimately generate creation of value in the business, which we benefit from and the founders benefit from. So as a result, that alignment is what we're looking for. And if that's missing from the start, and there is any sense of distrust on either side, it is much, much better for everybody to just walk away than try to persevere and get to a signed deal and funding.
So this is something that you threw out a word that and Alan and I in our pre-discussion, it came up in one of the questions was red flags. So we spent a lot of time talking about, and the first question was like, what makes a great pitch, right? Like, what do we do to get from no to yes? But talk to us a little bit more about what is a red flag beyond what you just mentioned. You know, what is like a, okay, hold the phone moment for you guys? When does that come up?
There are lots of red flags. So let's take a step back and talk about a little of why people are successful early stage investors. And this is not just for angels. This is for VCs and even in the PE community. It's about pattern recognition. It's about understanding what works in a marketplace and seeing when a new opportunity comes, does it have those same criteria to be successful in the marketplace? And do we have the right expertise to help them be successful in the marketplace? So with that in mind, deviations from that are potential red flags. So what are some of the ones that we have to deal with? Not having expertise in-house, where you're completely driven by outside consultants or otherwise, that's a red flag. Having a founder that is really, really good at selling, and they try to provide a sales pitch as opposed to an investor pitch, that's a red flag because they don't understand who they're speaking to. Having very, very complex deal structures or cap tables when they come to us, those are red flags. I've got deal terms in front of me right now from a company that I can't figure out who their investors are and how they got involved and what the valuations are. I have absolutely no clue. And it's with one of those, we just oftentimes just throw our hands up and go, look, I got too many other opportunities that I don't have to think this hard about. And that's the last part, which is, if a company comes in and they're going to make my life really difficult to understand what they do, understand, who else is in the deal, understand who leadership is or any of those sorts of things, ultimately, you can view this one of two ways. Either I'm lazy and I don't want to go there, okay? Or the complexity is problematic for getting follow-on investing and everything that needs to happen with most of these companies. It doesn't matter to me which way you're going to view me because it's going to get to the same outcome, which is I'm just simply not the right investor for that. But make it simple, make it straightforward, let us dream with you. That's what we want. And I've been watching the Q&A, so I do want to answer this other thing. One of the questions is, do we do stuff that's not techie, that doesn't have those sites, those kinds of potential returns? And the answer is we tend not to. And the reason for that's very straightforward. We're putting in risk capital. We recognize it can all go to zero. So as a result, the upside needs to be significant enough to be able to reward us in the few companies that do get to a successful exit. And by exit, by the way, for whoever asked the question, I mean investor exit. Because as an investor, once I'm out, what you do going forward with your company is really up to you. So that could be management-led buyout. That could be an exit to a competitor. It could be an IPO. We've done them all. And ultimately, what we're looking for is give us a financial return after we have created value together.
Sorry, David, you want to add something?
Yeah, I can add a couple of red flags. So
Sure.
so most of a number of folks in our group are really practicing the lean startup methodology. So business model canvas, product market fit, those types of things. And the idea, one of the main concepts is before you build the thing to the final nth degree and then go show it to customers, you really want to test some of the hypotheses and get some evidence as early as you can in the process. And we've had a number of groups that couldn't actually show that they've done the MVP work. They've gone and done customer discovery to get initial reactions. It's more about they had a technology, they didn't have a business and didn't have the path to a business. So looking to see that connection is really important. Another thing that has been a challenge in some pitches and was a red flag is when the presenters couldn't actually describe the technology in a way that the layman can understand it. We've got a lot of tech-oriented folks in our group, but there have been some pitches that have been so esoteric into the science of things that we couldn't understand it, and we won't invest in something that we can't at least understand or learn. So make sure that you're able to show that you can describe the benefits. And the other thing that we talked about a couple times already is just the integrity. You want to make sure that you're connecting with the group. And also show that you can listen and take suggestions and engage in a conversation, not just bowl through a pitch. We want to make sure that there can be an ongoing conversation if it's something that we're going to invest in.
So we've had Ellen doing a fantastic job, and really appreciate that, dropping some information into the chat box, but I want to bring it out of the chat box. And we've been tossing around a lot of words, a lot of phrases that, depending on where someone is in their own business life cycle, they may not necessarily be familiar with minimal viable product, something like that, or what a cap table is. And I'm not going to sit here and have us kind of go through each one, but Ellen, can you talk to us a little bit about if somebody is looking for information, is looking for inspiration, books, websites, people, give TED Talks, whatever it is, right, where do you recommend they go to really get their head around this nicely?
Right. So the best way is to really immerse yourself in the language and around the people. So some of the events that I mentioned, especially Venture Cafe, is a great way of getting yourself immersed in the language and picking up, what people, you can get a lot of advice, and I find that to be a very helpful thing. It's every Thursday night. I think the Y Combinator has something called Startup School, and you sign up for free. It's not the big Y Combinator, that's created that's helped launch Dropbox and other things, but they have a program that you sign up for free, and they take you through they take you through the startup journey. They give you homework assignments, huge amount of resources. It's really terrific about how to do the startup. When you want to move to when you're ready to start doing a deal, you have to have a good startup attorney. Do not use your aunt who's a divorce attorney. Don't do that. You've got to have a startup attorney. But before you talk to the startup attorney, you want to be up to speed on some of the language so that you're not wasting time and money. And so I put a few resources in the chat as well. So Seraph, SERAF, has a blog that goes through term by term in a really understandable way. They go through cap tables. They go through an explanation of what investors are looking for. It's a really good resource, as is Brad Feld's book on how to be as smart as your lawyer, your lawyer or venture capitalist. And one of the things they do there, which I love, is they'll go through the terms and they'll say this term is really important, and the investor isn't being a jerk asking for this. Here's why they want it. Or they'll say, if your investor is asking for this, they're a jerk, run away. So I really like that book for that reason as well. But I think if you immerse yourself, the Million Cups, the venture cafes, Philly Tech Week, I know I'm Philly centric, but there's stuff on UD's campus going on all the time. There's just so much programming these days. So take advantage of that programming. Take advantage of office hours. Robinhood has it. I'm sure some of the other groups do it. And that's a great way of getting in front of the group. They say, if you want money, ask for advice. So if you go to office hours, you're not pitching, you're asking questions. And it's Robinhood investors who are on the office hours, and they'll listen and they'll say to you, "This is really interesting. You might want to think about this or that with your business model. You're not ready for funding. Here's 3 milestones you have to hit. When you hit those, come back and talk to us." But you've already got someone on your side when it comes time to apply. Or they might say, "Gosh, we love this. Please apply right now. Put my name on it and I'll shepherd it through." So that's a really good way of getting to know investors, and different groups do that in different ways.
A question in here, you mentioned Y Combinator and Dropbox. So let's throw out this one. Are there any pre-existing public pitch decks that you would recommend looking at as a reference point for a good pitch? So there are a lot of, the major companies out there, Airbnb certainly coming up as one in my head, but talk to us about what, who, if I'm trying to get a good swing in baseball, I'm going to watch Ken Griffey Jr. Who's the Ken Griffey Jr. here for your startup companies?
Yeah. So one of my favorite pitches of all time, that's you can actually see her deliver it, which is more interesting than just looking at the pitch deck. I'm putting it on here right now. If you Google Leah Diagnostics Dream It Ventures, it's a short pitch. It's 6 minutes. She does such a great job, I think, of covering the bases and showing you the passion and telling. She tells a story, which is storytelling. Carmen Gallo has a great TEDx talk about storytelling. So that's a good one. Glenn, David, what pitches do you like that are out on the internet?
So one of the ones I like about for sort of early business model work is called Owlet, OWLET. And it was actually a business model, a college business model pitch presentation. But to me, it really did a great job of articulating the whole business model. And to the last question you asked, any other resources, books and things, there are a couple of books in the series of business model generation, value proposition design that are two of my favorites. A very graphical way to describe your business so that you can look at the business on one page, but also articulate that to others, and forms the good basis of a pitch. And then the other resource would be steveblank.com. Steve Blank is one of the original founders of the lean startup type methodology. And he's got all kinds of free resources on his website, and really talks about how you'd actually tell the story of your business and be able to engage others in the journey that you're taking.
I put in the chat, and I put in the names that David just said in the chat, but David Rose does a 11-minute TED Talk that you feel like you're out of breath when he's done, but he covers so much good stuff. So if you Google David Rose TED Talk, that's a good one too.
I'll offer one warning. It's very beneficial to watch really well done pitches by other people. But ultimately, the one thing that every good entrepreneur needs to understand is what their individual company's value proposition is, and make sure that gets drilled home. You can have an awesome narrative and pitch, but if it's somewhat vacuous in terms of the detail that makes you special, you're still not going to get funding. So it's that special combination of understanding your own value proposition as an individual, your company's value proposition in terms of the technology, the differentiation that I spoke about earlier, and then being able to weave that into a narrative. Understanding that the narrative actually is the third of those three, that you've got to be able to do the other two, or the quality of the narrative does not matter.
Got a question up here about something called, and it's put in quotes there, referring to it as investment purgatory. We're finding that generating revenue between 500,000 and $1 million is more difficult than pre-revenue and greater than $1 million. So it sounds like they're just feel like they're sitting in a weird spot. Can anybody address that? Help them maybe get some thoughts here?
Yeah, because I don't quite understand the comment. If you are they commenting on raising money with revenue, or are they talking about increasing revenue run rates? If you can make more money, the question with less income, right? Meaning your margins are better. That's fine. Why mess with that if you're happy with it? So I was just sort of confused by the question. So if the questioner wants to clarify that, I'd appreciate it, and we can come back to it, Michael.
Yeah, that's totally fine. Well, Gary, if you could keep an eye on the Q&A for that and paste it in if the questioner wants to clarify for Glenn. Okay, last question kind of on this. We've been talking a lot about sort of, learning from other people's mistakes or trying to avoid mistakes. What is something that founders or business owners spend too much time on? What's something they think is important that isn't? Or what is, and the same side of that, what is something they don't realize is important that absolutely is? So this is about, maximizing where you put your time. And that's really the resource, most valuable one that most founders have.
David, you want to go first here?
Yeah, one of the things for me is there's so much uncertainty in the early stages, but people try to gain certainty by doing really great spreadsheets and really detailed financial analysis. And I'd much rather have a much stronger story on the business model and value proposition, and identify what the uncertainties are, rather than spending the time on the spreadsheet. So I talked earlier about the lean startup methodology, and the approach is get away from the 30-page business model. Business plan, and actually drive that into a clearly articulated business model, value proposition, and story to go along with it. That's much more important than the detailed book, because the book's got all kinds of errors. It's got all kinds of assumptions, and it's not really the reality that you're living at that time in most cases.
Okay, I'll echo David, because I agree wholeheartedly. The further removed from today you are, the less I believe your financial projections, the less I believe your market projections, and the less I believe that you have the competitive landscape correct. Because the one thing we know is all three of those things change with each and every hour, much less day, much less year. So awesome. Spend all that time doing 5-year forecasts. Just know that most investors are going to discount every assumption the further away from today you are. It's just the way it works. The other side of this is penny wise, pound foolish behavior. Way too many founders get very concerned with the minutia details around a dollar here or a dollar there, rather than being focused on the big activities that will swing their entire company in a positive fashion. So, for example, the CEO that insists on doing their own bookkeeping, even though they're a PhD engineer, for example, rather than having an outside CFO/CPA do that for them and free them up to go out and either create their next great product or sell their current product, both of which are going to create far more value for the company and for the investors than them making sure that the checking account agrees with the cash flow. This sort of penny wise, pound foolish thing, I understand. Often we deal with founders that are running their companies as they do their personal lives, and they want to balance all of this and take responsibility. You can't scale companies with that attitude. You scale companies by bringing in the right resources and empowering them to make your organization better. And if that costs more, then as the founder, you go out, you figure out how to sell more and make more to enable them to do their jobs.
Great. Pulling together a couple of items into one. How early do you guys as angel investors begin tracking a company that you might be interested in? And within that, what becomes the right moment for a founder to reach out to you? And this directly from our Q&A. What's the best way to make first contact aside from a warm intro? So, I know someone who knows you and we make the direct contact. Any thoughts on that?
There's not a one right answer to this, because as you were asking the question, I was just thinking, when was the first engagement I've had with companies that I've either funded or I've worked through and still hope to fund? Sophomore year as an undergraduate. I mean, is that the right criteria? Because I've got one of them. I got another one junior year undergraduate. She didn't even want my money. She went out and raised 15 million from VCs, and I didn't even get a piece of the deal. So look, the answer is the earlier you can engage, the more likely you are to have an understanding of what funders are looking for, the better you're going to be at positioning your company to get funding. So part of it is educational, and part of it is relationship driven. And in this business, it's still a lot about relationships. It's about knowing who's looking for deals, what sort of deals they're looking for, what stage they're looking at. If you're talking to VCs, often it's about, who's got fresh money in a fund versus who's trying to close out a fund. The nice part about dealing with angels is we tend to be more evergreen because we've always got new members coming in and we're always doing deals. But, understanding that part of the dynamic really falls to founders. And it's, not easy.
For the areas we've been involved, there's typically been a connection to a member to bring it in front of us. Now, when we first started, we were so excited about being involved in learning about these companies and identifying things. The joke was we haven't met a company that we didn't want to invest in. I think as we've actually learned more and developed more as a group, we do want to make sure that there's initial connection where you do some pre-screening. So we're doing much more pre-screening. We've definitely met a number of companies now that we don't want to invest in, and we're trying to use that learning to identify how we can find the ones that are exciting to carry forward. So the connections are typically personal. We don't have a website where we're really trying to build what our structure is, what governance process we use even internally. So today it's a connection, and going forward, maybe it'll be more formalized, but you want to make sure that there's a relationship. Someone actually buys into what you're saying and they feel excited enough to bring it to the group to have a conversation.
If I could just amplify a little bit what David is saying. So it's not realistic that everybody, so it's important to have that personal relationship. It's not realistic to think that everybody on this call has a, you know, a friend in an angel group on their speed dial, right? So first of all, I'm going to volunteer. You've got people like Mike Rinkunis on this call, you know, Michael Chesney on this call, who know investors. They can help with the warm introductions, but much easier. We all go to events. So some of the events I mentioned before, I make sure someone from Robinhood is at every business plan competition, every, you know, venture fair, every forum. There are investors at these events, and that's a way that you can get to know them before it's time. Before it's time to apply.
Just out of kind of curiosity, and for, you know, for people's understanding, could you ballpark in some form the number of deals you end up with versus the number of businesses who in some form reach out or contact you? Are we talking, is it 1%? Is it 20%? What does that end up looking like?
I think the industry average is 1%, right? That actually get funded.
The issue though, Michael, is twofold. We get a fair number of companies that apply to Robinhood that for whatever reason we wouldn't do. Okay. We get foreign companies that are in unstable countries that have no rule of law. Okay. That's sort of a disqualifier for us. You know, it just doesn't make sense. But we also get a lot of domestic companies that are just in industries we don't have expertise in. So as a result, we move them aside. You asked me to comment on daycare centers. I figured I'd have an opportunity, and here it is.
That'd be great.
Daycare centers are a business model that usually do not scale to the point of being risk capital oriented. And as a result, I've had discussions 15 years ago at Robinhood as, hey, these are the sort of things I like to do. Is there an interest in Robinhood? And the answer was, you know, no, because they're not programming towards exit. They're programming towards providing really, really high quality daycare in underserved areas. And for me, I'm good with that because I'm taking what I would consider a below market rate return on my investment, because I want to affect change in communities that matter. Okay. That's the departure between, hey, I invest because I want to maximize return. Okay. Maximize what sort of return? There's financial returns, there's societal returns, there's environmental returns. I mean, there's a lot of ways to evaluate returns. And every investor is going to have those criteria for themselves. So there are a number of investors in the community that have other criteria. They're looking at society-based, they're looking at what we call impact-based returns or investment criteria. So if somebody has something that is directly going to impact an area of need, there is probably an investor that's focused on that. We happen to be a generalist group. That doesn't mean that we don't do deals there, but our priority tends to be financial return, and then the other returns fall below that. There are other groups that put the other returns above potential financial returns. So Michael, for me personally, daycare centers are where I put other returns above my financial returns, because I happen to take great joy in being able to walk into a daycare center that I helped enable and see a whole bunch of kids running around having a great time being prepared for success. That's a personal thing. That's not a financial thing for me.
So it sounds like, and this maybe is, one of those really great overarching points we were trying to get to that applies to any business, is really finding the right person is, and the right group is key, because you end up going to somebody, as you mentioned, who doesn't have someone with any expertise. And David, you were talking about this as well, doesn't have any expertise in the industry that you're looking at. You may be a great business. You may be very scalable, but it's just not for us. And so it sounds like that's kind of the point that you're making.
Mm-hmm. Yeah, look, there are awesome small businesses out there that are just not good fits for the investment we do at Robinhood. That doesn't mean, number one, that we don't have Robinhood members that might be interested in doing it outside. For example, I have a long history of doing real estate investing. Robinhood doesn't do real estate investing. So as a result, if you want to talk to me about real estate investing, it's not going to be through Robinhood. That's the case with virtually all of these things. And that's the reason why having dynamic members, and I think David can attest to this, having members that really want to get their hands dirty in deals is hugely important to being a relevant investing group, whether you're doing all of the deals through the group or whether some of them are just subsets of the group going off and doing them. You're still part of the overall community. And that's a big part of what we're talking about today, I think.
Okay. So we've got a few more minutes. It's almost 12:56. And as I've said a couple of times, time is really the big thing that founders and entrepreneurs really don't have a lot of. So we're going to try and start to wrap this up. Let me, Glenn, throw the one question to you that we wanted to come back to. So they provided more information. Many investors were connected to quickly indicate they're either focused on pre-revenue or require over $1 million.
Yeah.
We have hit approximately 500K in 12 months. Our market's highly fragmented and our need for accelerated commercial investment is time sensitive. Your answer suggests that I may just not be qualifying the investors as well as I should.
Yes. And I think it's Mike, I believe, is who put the question in. I believe that is exactly the case, is that you need to talk to angels, because with 500,000 in revenue, depending on the quality of that revenue, and that's beyond our discussion at this point, you're probably in a sweet spot for a lot of angels because you've proven your business in terms of product market fit, because there are people buying it. Okay. And you haven't gotten so far that your valuation is beyond what angels are willing to invest in. So submit to Robinhood. I mean, that's all I can say at this point. And you know, if David wants to see you submit to his group, also do it, because you should be right there. Now, without knowing the business and the quality of the revenue and all of that, I can't comment. But that's the sort of company that we usually really embrace. So I'm just sorry we haven't seen you before.
All right, I'm going to throw one last question out, just one that Ellen had mentioned again in our pre-discussion that I just really like. So we'll end the formal part of the Q&A here, and then we're getting a lot of questions on contact. So we'll end with that in a second. But in the time that you guys have been doing this, is there and David, obviously it's a little bit shorter of a time frame, so probably not something that you'll have had experience with yet, but at least for Glenn and Ellen, is there a business that came to you with an idea and it is your son of a gun, I wish I had?
Oh man, well, this is unfair because Michael sat through the class, and that's actually one of my big criterias, which is I tend to really warm to investment opportunities when I look at them and go, oh, wow, I wish I had thought of that. So for me, there's lots of those. I'm going to bring one up because it's a Delaware company. It happens to be a portfolio company of ours, and the company's Throughport, which I know some of the people on this are familiar with. It's an advanced materials company that the founder, as part of her graduate research, came up with a different way to make carbons that gave them awesome surface activity. I'm a material scientist by training, so I look at that one from a pure technology standpoint and go, wow, I wish I had thought of that. So yeah, I encounter those all the time, Michael.
Well, what about, Glenn, one businesses, that's a great answer. Wasn't actually the question I was asking. I should have been more specific. What about a business that came to you and asked for investment and you didn't invest? Is there one that's the one that got away that specifically comes to mind?
Well, he's thinking, I can tell you, Josh Koppelman always tells the story. I don't know if you know Josh Koppelman. He's a very prolific investor in the international, but he turned down Twitter. Twitter came first, right? He turned down Twitter because he thought it was overvalued. So that when Square came around, he's like, I'm not going to be this stupid again. And he did not even care what the valuation was, and he got in that one. But so we all have those. I know we had one that was it was a diabetes diagnostic company. This is maybe 5 years ago, and the entrepreneur was constantly contacting me and saying, you are missing a great deal. And I remember saying to him, can't get the group interested in it, really sorry, but I promise to call you. I'll send you flowers if you're successful. And they had a huge exit, so I sent them flowers. But we that was a $300 million exit, which we did not get.
And I think that the nice reason to end on that question is that a no from a investor is not a reflection of the quality or the potential of your business. Right. And maybe that's also a really important lesson for people to come away with. There maybe you have more work to do, but just because someone says no doesn't mean their opinion is the be all and end all of everything. So
it's not a dead no, it's a no, you need to do these things, come back. And that we're not just brushing you off, right, David? We really mean come back when you've done these things.
And it may just not be a fit for that group. They might be a perfect fit for another group, and you just didn't make that connection.
I can tell just based on the chat box that a lot of people who really enjoyed this and appreciated everything that you guys have brought to the table today. We'll wrap up by hopefully initiating a warm intro. If people want to connect with you, if they have questions or they want to make a pitch, what is the best way to do that? David, I'll start with you, but because you put it in and then it looks like Alan's adding it now, but David, how can they reach out to you?
I think email or LinkedIn, both work. If you're going to send me a LinkedIn, please put a message along with it, not just a nameless or a messageless invite to connect.
And if you lost it in the chat, Dave, LISSDAVE at Comcast.net. And Ellen?
So the best way is info at Robinhood Ventures, and it'll get to me. That's the best way.
Great. Glenn, if they want to reach out to you, should they go through Robinhood as well?
They can go through Robinhood, although I know LinkedIn's working because I've already had 4 people ping me on LinkedIn since we started, and I have a feeling I'll get a few more. I'm much like David in this. If you're going via LinkedIn, at least give me some idea of why you found me there. That is, yes, yeah. Please don't just stalk me on LinkedIn. At least tell me why you are stalking me. But that's a great way. It also gives you a little bit more background on who I am and my experiences as well. So all told, that's a great way to reach out.
Right. Well, thank you guys so much for taking the time. I know I really appreciate it. The Division of Small Business does. It's a great way for us to, share some great information with people for Small Business Week. It's always a a nice thing. We try and do different things each year, and I've been really glad to be able to share some of this investment and getting investors on board. And speaking of that, if you were not able to attend yesterday's webinar, but you're interested in learning about equity crowdfunding, which is, when we talk about angel investing here, these are all qualified investors. They have a lot of money, but if you're looking for those people who can put $100 into your company to help it grow, equity crowdfunding, absolutely check it out. We had guys from WeFunder, it's a platform for that on, and we have an hour-long webinar that's available on our Facebook page to watch. That is Delaware Small Business on Facebook. So head over there and take a look. Again, thank you so much to everybody for joining us. Thank you so much to Ellen, David, and Glenn, and have a great rest of your day and week. Bye-bye.
Thank you.
Thank you.
Take care, everyone.